Hello, one. Hello, all. This is Andrew Cox on a very special episode of Great Quarter Guys, where finance and freight meet. This is FreightWaves Live at Home. I'm your host, Andrew Cox. Of course, this is with me, Kevin Hill.
It's an exciting morning.
Very. It's been fast-paced. We're running around like chickens with their head cut off around here.
It is. It's like it is a real TV set, but it's got all the action and movement today of just bouncing around and everyone pitching in, and a great job by the crew here, keeping everything on track, keeping us on track, our time on track, definitely.
Yeah, we need a little help in that department every time. So
yes.
Shout out to them. But like I said, this is Great Quarter Guys. For anyone who hasn't watched, we typically do a business segment breakdown where we'll break down a company, a transportation company. We'll look at their earnings whenever it's earnings season. That's what we've been doing for the last couple of weeks. But rather than do an earnings segment today, we actually have a very special guest. We're going to have Ben Gordon, the founder of Cambridge Capital, on in a few minutes. We're going to talk a little bit about innovation and where the freight industry is going in the next couple of years and how COVID-19 is going to impact where investment's going to be placed in the next couple of years.
And it's going to affect it in a large degree over the next couple years, and we're going to find out more and more about that from Ben here in the few minutes. But as always...
Yeah, we typically do something I started a couple weeks ago is this segment called One Good Piece, and it is my attempt to find one good piece of economic data out there in the world right now, because we've had so much poor economic data the last couple weeks that it's been very difficult to find one. And for anybody watching last week, I do apologize. You may get on to me because I'm using the same one as last week because I got the data updated and it's even better. This is the Bank of America debit and credit card spending. I just talked a little bit about it on FreightWaves now. This is really constructive for me. If you look at this Bank of America spending data, you see an immediate bump from the stimulus check, and especially in online retail and online electronics. But you see that consumer spending has bottomed in every category, which is really good. You know, we're going to have this data updated weekly. I'll give you another update on Thursday, probably in the DHL Supply Chain Pricing Power Index. But either way, consumers are starting to get out and they're starting to spend some money that has not happened in the last couple months. So I'm excited to see it.
I love this data. It's so fascinating because it gives you year over year by week. So it's a weekly data set. It's all year over year. So you have a sense of the troughs, so the peaks and troughs of it. And as we said, it's the last 2 or 3 weeks, it's bottomed out, kind of like with the outbound tender volume index, and it's on the uptick. And it's interesting, what hasn't bottomed out is travel, entertainment, restaurants, not really bottomed out, but, retail spending has bottomed out, as well as, well, one of the big bright spots throughout this whole thing is home improvement and construction. The Home Depots, the Lowe's of the world, the Ace Hardwares are all doing really good right now.
Yeah, it may be some time before we see durable goods come back online to the full extent as it was pre-crisis, but we're going to see retail spending pop up pretty quickly. But that is the one good piece for this week. We'll have another one for you next week. But let's go ahead and let's bring in Ben Gordon.
Let's do it.
He is the founder of Cambridge Capital. He'll be joining us. I think he's in Palm Springs right now. Ben, how are you?
Great. Palm Beach. Sunny Palm Beach, Florida. Looking great here. Yeah.
Well, good to hear, Ben. Why don't we let's start a little bit with the history of Cambridge Capital. Give us the 90-second elevator pitch.
Sure. Happy to. And Andrew, Kevin, great to be here. I love that Bank of America data that you shared. It was very compelling, and it certainly highlights what's happening in the economy. So a little bit about us. We're a private equity firm that invests in great companies in transportation, logistics, and supply chain technology. We're entrepreneurs at heart. I've started 4 companies over the last 20 plus years. 21 years ago, I started a company called Threeplex, which was one of the first SaaS logistics companies. We called it something else then. The names changed, but the fundamental premise was using the internet to deliver TMS capabilities to 3PLs, and venture-backed, raised $28 million, sold it. It's now part of Maersk. Realized that it was more fun for me to work with other CEOs building their businesses. And although I've been an entrepreneur 4X and have partners who've built other businesses too, our primary focus has been investing in great entrepreneurs in all areas of transportation and logistics. We were fortunate to be an early investor in XPO, Brad Jacobs, 9 years ago, when it was really a startup, and then the acquisition of a $10 million EBITDA expedited freight business called Express One. Of course, now a $16 billion powerhouse in logistics. And We take and deserve no credit for that. Obviously, Brad was a fantastic CEO and did a fantastic job, but got to play a small role and be a small part of that. We've been an investor in other great companies, Grand Junction, which is e-commerce and last mile logistics. Another great entrepreneur, Rob Howard, whom we backed in 2015. Rob did a tremendous job and ultimately sold the business to Target, really giving Target an e-commerce platform to have a competitive alternative to Amazon Prime. We're closing right now on another business that we're excited about. And so really, for us, it's all about looking for great entrepreneurs, building great businesses in important areas of supply chain. And that's us in a nutshell.
Well, Ben, that's a great elevator pitch. Thanks for that. I know XBO and Grand Junction, I've read, are two of your best. You obviously know a lot about this industry. You've been in it a long time, started a bunch of companies on your own, helped out a lot of big ones. We know what's on the top of everyone's mind. Everyone wants to talk about COVID-19. Let's take a little bit of a different angle and just jump right in. I have a feeling that there's going to be a changing of burners here, so to say, on some of the advancements and technologies that people have been investing in over the last couple of years. Do you think there's any investments and innovations that are going to have to be put on the back burner because of this COVID-19 downturn?
Well, I do. I think this is a double-edged sword. On the one hand, clearly, COVID-19, in addition to being a humanitarian disaster and an economic disaster, is causing ripple effects in the world of supply chain. On the one hand, of course, it's killing companies that are asset-based or that depend on global or extended supply chains. So, air, ocean, the carriers as well as the brokers, actually. But it's been actually a catalyst for growth for many tech companies. And I know Craig Fuller posted on Twitter a couple of days ago that venture firm that he talked to says that his portfolio companies are doing better. We see the same thing. Right now, we're closing on an investment in a logistics technology company that grew 5x last year and expects to grow another 2.5 to 3x this year. And the data actually over the last 2 months has been going up. And why is that? Well, I think number one, it's because companies like the idea of technology that reduces labor, that reduces risk, that reduces the exposure caused by, of course, human contact, which is the vector by which the COVID-19 disease spreads. Number two, if you can use technology to boost automation, boost productivity, boost margins at a time when everybody's margins need help, that's fantastic. And then number three, I think particularly for technologies such as robotics, drones, automation, or artificial intelligence or software that drive increased productivity while reducing the need for labor. Like if you're a business that can double without having to add people, and therefore without having to add the risk of those people getting sick, getting exposed, and spreading the disease, why wouldn't you do that? So the interesting dynamic here right now is we've seen COVID-19 accelerate the pain that's being experienced by many traditional transportation companies, again, particularly on the asset side, particularly on the global side. But we're also seeing it help and accelerate growth of certain companies on the technology side. And so I don't want to be macabre about that. I don't want to celebrate that. It's a horrible thing that we're going through, but there is a silver lining for those companies in certain areas of logistics technology.
Certainly, Ben. You've mentioned a few of the kind of the hot topics of future innovations in the supply chain industry. It was from AI to robotics and automation. Is there anything that is on the cusp of becoming that's on the cusp of materially changing supply chains that people aren't really talking about right now?
Yeah. So there are the obvious things that everybody likes to talk about. Everybody loves talking about drones and robotics and digital freight brokerage, and those things for sure are important and they matter. But there are some more subtle changes taking place below the surface. I'll give an example. AI is one of those things that everybody loves to talk about it, but very few people actually understand what AI means and what AI does. We're getting involved with a business that provides AI tools to help 3PLs and brokers automate a few things. One, their ability to sift through all the data that they have and make sense of the carriers with whom they work, who's most likely to be reliable, what's the likely pricing going to be, what's the likely availability. And the bottom line is giving a broker the capability to make decisions more quickly. Well, that's pretty cool because, if you're a broker, your lifeblood depends on being able to make quick, accurate decisions and to push that to the front lines. And so if you can put more power and capability in the hands of the frontline guys who are talking to customers or talking to carriers on a regular basis, great, that's fantastic. So I don't know how sexy that is. That's more of a kind of behind the scenes capability than something that would necessarily be on the on the front of the paper or the front of FreightWaves.com or otherwise. But I think that's pretty important. I also think while a lot of the press has gone to the digital brokers that are trying to displace logistics companies, in fact, logistics companies are as important today as they ever were, and technology that makes logistics companies more powerful is something that, again, may not be as sexy, but may ultimately be more important. We see that in brokerage, we see that in freight forwarding, we see that in a number of areas across logistics. So software that makes the incumbent logistics companies do a better job, we think is going to do very well. And that was really the original premise for Threeplex over 20 years ago. So it's an idea that's been around for a long time. But the headline is always about how technology replaces the middleman rather than improving the middleman. And I think that's an important distinction.
You bring up a really good point, Ben. This is Kevin. So going back into AI and really the big data that we're seeing right now, this tsunami of data that's hitting logistics and freight, what are some of the technologies you see, kind of going back onto that point, that can determine, there's so much data, I guess the question is, there's so much data out there, how do you really manage it? How do you find out or determine what's the most important data and what is just noise in the system?
Yeah, it's a great question. I remember I had a professor in college 27 years ago, and I remember saying to him, this will make me sound old, I guess, said, there's this new technology coming out called the internet. And he said, I don't want to hear about any new information. I have too much information already. and that stayed with me because I think that's kind of how we all feel. There's this massive surge of data. And as ridiculous as that quote sounds, the truth is that we're awash in data, too much data, but not enough analysis. And so your question's a great question. How do you make sense of everything that's out there? And how do you focus on the handful of areas that really matter? Well, I think, number one, there are technologies that do a better job of capturing more data. And then number two, there are technologies that do a better job of making sense of what's out there. So there are AI tools that will sift through the data and look for trend lines. I mean, obviously, what FreightWaves is doing with Sonar is a great example of that. But if you can sift through all the data and then be able to say to your customer, whether that's a 3PL, a shipper, or a carrier, look, number one, here are the trend lines in terms of pricing, or number two, here are the trend lines in terms of what capacity will be available and won't, and then number three, allow you to start making better decisions. That's fantastic. And so, look, I think that's fundamentally what AI and big data is all about. We're an investor in a company called Bring, which is fantastic in this field for last mile. So what they do is they go to companies like Walmart, McDonald's, Panera, and other big brands, and they say, look, let us be the platform for orchestrating how you handle last mile. So that the data for inbound logistics, for direct to consumer or direct to store, and the analytics around that. It's not surprising that the CEO of that company came out of a $15 billion big data company called Splunk, and is really applying what he learned in that field here in logistics. So I think being able to sift through all the noise that's out there to get to the signal is super hard, super important, and super valuable. And we see that in a handful of great companies. Bring, we hope and expect, will be one that can capture that.
Ben, to pivot a little bit, thanks for that information. To pivot a little bit, what's your outlook on M&A and private equity and venture capital activity for the remainder of 2020 and moving into 2021?
Sure. So, I like the way I think about venture capital and private equity right now is deep pockets but short arms. Okay, so there's a lot of money out there, but very selective deployment of that capital. We've seen several deals that were, in the eighth inning, and then the capital partners pulled the plug just, in the last month and a half. Having said that, we're still involved. We're still getting deals done. We're closing one right now, as I mentioned. And I think while the total magnitude of capital, may get squeezed. So in the last decade, $30 billion of capital came into logistics and supply chain technology realm. Okay. We're not going to see the annualized version of that this year. It's going to be less. But on the other hand, we do see money coming into great disruptive freight tech companies. Valuations are coming down, and control provisions for investors are going up. But you know what? That probably was going to happen anyhow. I mean, if you look at the last decade, 2017, 18, 19 saw the highest valuations in history from a venture capital standpoint. And so if you were an entrepreneur, there was probably never a better time to raise money, than last year in terms of amount of capital that was available, favorable valuation, favorable terms. So I think that was poised for a pullback anyhow. Not like, any of us could have predicted COVID-19, but just based on the normal business cycle. So there are still deals getting done. Valuations have come down and terms have changed. But, fundamentally, for companies that are high quality, achieving strong growth, have the ability to succeed in spite of, or in some cases, with help from the impact caused by COVID-19, and with continued long-term growth, those guys will do great. And again, freight tech companies in the areas that I alluded to earlier, whether it's automation, robotics, technology that automates, reduces the labor intensity of work that's being done. Those companies, provided that they're growing and doing well, will be able to raise capital. However, fewer of those companies will succeed if they don't have a very clear path to profitability. Something that we're seeing now is the companies that are raising money are either cash flow positive or have a clear plan that ensures they will be cash flow positive without having to raise another round. Now, that doesn't mean that they won't raise another round, but it means that that's got to be a choice and not a necessity. The companies who think this round will simply buy them 12 to 18 months while they continue to burn cash, those companies, unfortunately, may find it much more difficult to raise capital. So that's what's happening on the venture side. There's a flight to quality, a smaller number of winners, but those winners will still be able to raise capital and ramp up. On the private equity side, a little bit different. Private equity side, number one, still plenty of activity, but private equity is fundamentally EBITDA multiples to buy large proven companies, and those large proven companies tend to be services businesses and logistics, right? Truck brokerage, freight forwarding, warehousing, and as a category, those companies are all squeezed. Right now, there are some companies that may be doing better. If you're doing logistics for pharmaceuticals, you're doing better than if it was truck brokerage for automotive, right? But big picture is a category. The asset-light logistics world and transportation and logistics, profits are down and multiples are down. You can see that in the public markets as well as in the private market. So there's a little bit of a struggle because on the one hand, you have great entrepreneurs who say, hey, if my business last year was worth $500 million and I'm the same guy and I've got the same team and the same capability, I think I'm still worth that $500 million. And then you've got investors saying, hey, that's great, but if your EBITDA is down 20% and multiples should be worth 2 turns less today than they were, pre-COVID-19, well, you might be looking at a 40% haircut. And so you have this gap between what buyers and sellers expect. And that gap may simply mean that you have a smaller number of deals that takes place for a while. This is what we saw in 2008, 9, and 10. It took really not until 2011 and 12 before the volume of deal activity rebounded to the 2004, 5, 6 levels. So,
hey Ben, we've got a question from the crowd here. Kevin, you want to read it off for us?
Yeah, Nafrad, forgive me, Nafrad. Nafrad Nadarevik has a question for Ben about all parts of the logistics industry in North America? And do you think technology and mankind come to a singularity where there'll be more room for mom and pop shops to thrive and stay alive, or will they have to go completely digital and integrate in order to stay alive in this environment? And he's asking this because he's got a small business, and Canada, the United States, is built on, think of just the people in your circles who own a business and have been affected by technology and now COVID-19. So really, will there be room for mom and pop shops going forward in this technological revolution?
Yeah, that's a great question, and I would unpack that to two parts. First is there a role for mom and pops in this world? Well, I sure hope so. I mean, as somebody who's been an entrepreneur, built for small companies, and our whole MO is to work with great entrepreneurs building great businesses from small to mid-sized to large. So I sure hope so. It's certainly, I mean, it is the American dream. I think for small companies today, for mom and pops today, one of the greatest tools that's out there is SaaS technology, software as a service, because if you look at the world 20 years ago, only the big companies could afford large 7-figure, 8-figure software, and that gave them an unfair advantage. Okay, so like if you look at the world of TMS, Schneider 20 years ago had a TMS called Summit, and they spent $60 million building it, and it was fantastic, but you weren't going to have access to Summit if you were a small guy. Today, you've got capabilities in the TMS world that are far greater than what Summit represented 20 years ago, and it costs far less because you can get it on a SaaS basis, and cost of computing power and productivity is so much cheaper. So I think being able to get smart about what technology is out there and being able to use those kinds of SaaS tools doesn't discriminate based on size. Small guys can use it just as well as big guys, and so I would for sure look at that. The second part of the question is really, you talk about singularity and this fusion between people and technology. And I think that's a great issue because a lot of people have framed what's happening in supply chain technology and tech as a whole as this epic clash between the people and the technology, right? Who's going to win? Is it going to be the big incumbents in services and brokerage like C.H. Robinson or an XPO or an Echo, or the technology challengers like a Convoy or a Transfix or a LoadSmart? And I think the real answer is it's not man versus machine, it's man plus machine. So the best companies will be people who are using technology to be more productive. And in fact, that's probably what you'll hear from guys like Doug Wagner, who I know are speaking here at FreightWaves today. Companies that take their great services and combine them with great technology, those guys do great. And by the way, at Cambridge Capital, that's what we look for. We look to invest in great companies that are built by guys in logistics and supply chain who know logistics, and then who use technology in order to boost their productivity.
Hey, Ben, I really like that statement you just made, man plus machine. It actually leads me into a topic I wanted to talk with you about, which was autonomous vehicles. This has been a very highly hyped and touted technology for the last few years, but, we've only seen a little bit of progress of what we think we would get there. And we've seen a lot of layoffs and a lot of closures over the last, especially in 2020. Starsky has shut down. Kodiak laid off 20% of its workforce. Ike laid off 14% of its workforce. Do you think that COVID-19 is going to accelerate? I've seen Vishnu, our tech reporter, say that he thinks COVID-19 is actually going to increase and speed up the process of implementation of autonomous vehicles. Do you think that's true, or do you think it's the opposite, and they'll have to take away from some of those investments?
Yeah, I think it's true, but there's some unintended consequences. So it's definitely true that COVID-19 will accelerate the usage of technology to boost automation, including driverless trucks. So for sure that's happening. But it's also true, as I alluded to earlier, that venture capital is less likely to invest in businesses where this round doesn't get the business to cash flow positive. So one of the problems with a Starsky or some of the other companies that were really going for it, and I want those guys to succeed, and I want that category to succeed, but raising money when you're on an endless treadmill of capital raised and you're not on the cusp of being able to get to cash flow positive, that's tough under any circumstance, but it's going to be a lot tougher in the current economic climate. So I think
Ben,
the answer has to be someone that can do both.
Yeah, so Ben, what do you think the winning strategy is going to be? Do you think it is a well-funded upstart, or do you think it's a legacy provider from outside of logistics like Uber or Amazon coming in? Or I think it's actually likely going to be partnerships between traditional transportation providers like the one with Too Simple and UPS right now. What do you think?
Exactly. I think you've got to have both. On the one hand, the automation and the technology that boosts productivity we talked about, and on the other hand, the ability to get to cash flow positive quickly. So you can do that in a couple of different ways. One is you can do it with a partnership like a Too Simple plus a UPS, and without getting into the commercial terms, if UPS in exchange for its adoption is generating enough revenue or is willing to invest or provide enough resources such that a Too Simple could get to cash flow positive relatively quickly, then I think they could do tremendously well, both guys. And on the other hand, I also think companies like Uber, Amazon, and others don't have the pressure of having to make sure that what they're spending money on becomes profitable within 3 months, 6 months, 12 months, because these are companies worth tens or hundreds of billions of dollars of value, and therefore they have more resources to deploy. Those guys will do okay. The startups that have no core strategic relationship or path to profitability or resources to get there, unfortunately, those are going to be the guys that have the hardest time. And they're the ones that will need to figure out, how do I form a partnership in order to change that structural economic?
So we have one more question here, Ben, from our audience, and it's coming from Robert Goach. He's a National Director of Sales, and it's what's the secret of companies being able to pivot their supply chains during a pandemic like COVID-19? What's that secret sauce?
The secret? Well, I wish there were an easy secret. There's not, but I think fundamentally, companies trying to pivot their supply chain during COVID-19 have to go from just in time to just in case. Right? They have to go from having global extended supply chains where they can run with really low levels of inventory because they're relying on low-cost manufacturing in China or elsewhere. And that model worked great 2019. Doesn't work great today because you can't count on those supply lines being open. So you end up having to shift your manufacturing to somewhere that's reachable by truck. And of course, that means having manufacturing locations in North America. Number one. Number two, it means you have to have closer, more strategic relationships with your 3PLs, your tech providers, and your whole supply chain in order to support that. And number three, it means building in more agility, more flexibility into your supply chain. And so, maybe that means that you spend more money on technology in order to be able to make those shifts, more readily. And the payoff of that is you spend more in one area, but then in the long run, you save a lot more in another area.
Hey Ben, I'd like to, you've talked a lot in your YouTube videos about Amazon. Of course, they're on the top of everybody's mind, and I like the discussion of Amazon versus everybody, who is eventually going to challenge Amazon if they're not really being challenged now. So, my question to you is, who do you think is best suited to challenge Amazon in the e-commerce solely? Is it somebody like Shopify and thousands of other independent retailers, or is it a bigger box store like Amazon and Target making a better play, making a more concerted play into e-commerce?
Yeah, great question. So who's best equipped to compete against Amazon? Look, I think one scenario is that you have an e-commerce competitor like a Shopify or an Alibaba. Alibaba may be even stronger, that can create an ecosystem around them, which includes technology, as Shopify did with robotics when they bought 6 River, or the e-commerce fulfillment companies that they use, or last mile companies or others in the ecosystem around them. I think those guys have a very good strategic position to accomplish that. I think secondly, there are companies, like the retailers and, guys like Walmart and Target that have the ability to say to consumers, you can order online and pick up from the store. And that capability seems to be a little bit more valuable right now, actually, when again, you've got guaranteed access to the inventory and the supply chain around them. There's a third possibility too. The third possibility is somebody could emerge as kind of a 4PL that involves best-of-breed players for truck brokerage, warehousing, freight forwarding, e-commerce, last mile, autonomous, robotics, kind of all these different subsets of supply chain, and could effectively be a 4PL supply chain manager organizing the whole thing. I think, and what's interesting to me about that is it's kind of like the battle between Apple and Google, battle between a closed or walled garden and an open ecosystem. So Amazon ultimately may represent that Apple-like model of a walled garden. So there's room for someone to say, well, we're going to come up with an open ecosystem that puts together the best of breed supply chain players in each of those areas. That company may be around right now but hasn't talked about it yet. Or maybe a company that hasn't actually been launched yet. But I think there's an opportunity there for sure.
Hey, Ben, so we've talked about a couple of your successful deals the past few of our moments together, but what's one lesson you've learned from a deal that went south, that didn't go your way, that you've learned from since then?
Oh, God.
Sorry to put you on the spot.
We've all made mistakes. We've all made mistakes. You know what? Let me start with my very first company. First company that I started, Threeplex. We had a big vision. We wanted to be again, today you would call it SaaS for logistics. And really our primary focus was using the internet to provide superior optimization of supply chain networks by building a better TMS. And we raised a lot of money. We raised $28 million, and we spent most of it building out the TMS. And our strategy was to empower the 3PLs to succeed. Okay. The marketing was great, but the sales was terrible. Okay, why was the sales terrible? Sales was terrible because ultimately 3PLs, and this is true 20 years ago, it may be less true today, didn't want to spend seven figures on software for something that we had. They were very happy to pay for it if they could pass it on to a customer, right? So effectively, they were like a VAR, a value-added reseller. So if a 3PL said, "Hey, I love this software, and I'm going to use you to go pitch Walmart or so some other end market," great, then that would work. But they weren't going to spend the money up front. And so we spent a lot of time and money going down that road before realizing that. And gosh, I wish we'd realized that in the beginning. We could have saved a lot of time and a lot of money. Ironically, and I think every startup has to learn how to pivot. We had also created a product in drayage that allowed you to match freight with capacity and create a tracking and visibility tool for drayage. So when steamships come into the ports in LA Long Beach or Newark or elsewhere, the communication between those steamships and the drayage carriers that do the short haul trucking as they queue up in those ports. And that's a much smaller market, right? But it turned out that it was a bigger problem that nobody else was solving. And in the end, Maersk, the steamship giant, bought Threeplex, and they bought it for a lot less than I would have hoped for and a lot less than what we'd all drawn up in our plans at the very beginning. But they bought it nevertheless, and they bought it because they valued the drayage piece. And so lessons learned. Well, number one was being as a 26-year-old cocky entrepreneur, there was a lot more that I didn't know than that I did know, and a little bit of humility and reflection went a long way, and I think still does. That's true for me, and I'm sure it's true for most of us. Lesson number two was the idea that we thought was the right idea turned out to be wrong. Because fundamentally the 3PL marketplace didn't want to spend the money that we thought they were going to spend, and it required pivoting. And it was, and I think, an important lesson to listen really closely to your customers and be prepared to make changes where and when the market dictates. And then I think lesson number three was I was a guy who had some experience in logistics, but not a lot. I had a family business. My grandfather had started a truck leasing company, and I had some exposure. But I wasn't a guy who'd spent 20 years, in operations in logistics. And we put a team together that combined people that knew logistics with people that knew technology. And I think if we'd probably hired a couple of more senior people with experience in logistics to really map the market, the business process, and understand the customer problem before going out and spending as much money as we did on technology, we probably would have gotten to the right answer faster. And so listening to the market and having industry people, on the front lines, certainly super valuable. So those were three lessons that I learned that have helped me in the subsequent businesses that I've been involved with.
Well, great. Thank you so much, Ben. That was a very succinct answer. A good finish there. This has been a great conversation, man. I hope to talk to you again soon, and have a lovely day. Enjoy the rest of FreightWaves Live.
Thank you, Kevin. Thank you, Andrew. Great being with you.
Thank you.
You're welcome, sir.
Kevin, we'll have to have Ben on future shows of great quarter guys,
Most
and really
definitely.
get into it's hard to get into a really deep level in 20 or 30 minutes on a single topic. We kind of wanted to talk about a few different things.
Right. You know, at the end there, one of the lessons that he almost got to saying it was something that I heard you say on one of your LinkedIn videos the other day, is that if you build it, they will come. Is kind of that mantra that we learned, and that's one thing that he learned, that you still got to sell the hell out of it.
You do, yeah, and that's one thing I learned as an entrepreneur too, is that build it and they will come is the worst advice and the worst philosophy you could ever do, and we'll probably talk a little bit about that tomorrow on Put That Coffee Down.
That's right.
With Dooner and our great George Abernathy. But let's get to, we have limited time now.
Yeah, let's do the long shorts.
So this my favorite part.
Yeah, again, for any of our new viewers, we do, every week, we'll do one or two long shorts, which will either do a company or a general idea that we're either long or short on, and we'll ask what they are. So we've got two for you today, Kevin. The first one is SAIA, the LTL company. They reported this week they're the fastest growing LTL company in the country, and they've really stopped trying to undercut ODFL on price, and they've really started to focus on service, especially there on the West Coast. What do you think about SAIA?
I think they're going to continue the growth. It's been a tough quarter or two for LTL. LTL, I think, took the biggest hit during the COVID crisis, the pandemic, because of volumes and small businesses. I think it's going to be a good second half of the year for LTL as small businesses come back online. So definitely long. I think they continue their growth. There's that market out there, and they have their segment, not really a niche, but their segment that they do really well targeting.
Yeah, I got two reasons I'm long. The first one is their focus on the West Coast. I think they'll benefit greatly from that West Coast being able to pick up, and it's likely going to be a slower pickup than the East Coast. But I think they're positioned well there. And then the other one, I think that shippers are going to test out the market for demand. I think they'll utilize LTL a little bit more rather than sending full truckload, just to kind of test demand, test the waters, and feel out demand. So I think that positions all of the LTL carriers.
And that's a really good philosophy on demand, right? Because I don't think demand's going to. It's not going to be V-shaped back up to 100%. You're going to see 60, 70, 80% demand come back online slowly. So that's a bullish case for LTL companies.
Well, good. So we're both long on SAI.
Yeah.
I've got one last one for you, and it is about airline passengers. This is something that you've been very adamant about on LinkedIn. He's been posting a lot about it. So I have a question for you. Do you believe that air passengers will average 1.5 million passengers for an entire month at any point in 2020? And some data here that will give you some context. In 2019, it ranged between 2 million and 2.5 million every day of the year. They're currently running about 7% of 2019 levels, but that number has almost doubled off the bottom, so they're up 25% in just the past 2 weeks, but again, only running single digits of 2019 numbers.
Yeah, so in April, it got down to 90,000. So, and this is the TSA passenger check-in. I've been following this pretty closely. It's fascinating data because last April 2019, you had, say, roughly 2.5 million passengers a day going through TSA checkpoints. It got down to 90,000. The last couple of days, it's been 170, 180,000, so it's doubled off that bottom, but you can't even put it onto a year-over-year chart, and you can't really see any movement because the scale is so high. You've seen Delta, Southwest, American, United all saying that they're going to be a much smaller airline, cutting flights 90%, Ryanair in Europe 99% flight cuts. So, and they're all saying it's going to be 2 or 3 years before we get back to anywhere near normal levels. So I am short airline passengers for any time in 2020, averaging 50%, which is about 1.2 million.
Yeah, about half.
Roughly half. I am going to go short that just because I think until you get a vaccine, being in a cabin full of other strangers from all over the world is scary.
Yeah, I am short as well. I think just a quick note is if Warren Buffett's out, if he's seeing something, there must be something in the water. He's of course sold all of his airline stocks, and his reason was he doesn't think business travel will ever pick up to to pre-crisis levels. I mean, look at how Zoom is impacting business meetings. Look at us right now doing this whole virtual conference. Right. Nobody had to travel to Atlanta to do it, and we're moving right along. So I think we're short too. I think airlines is going to be short, and that actually that brings us towards a close. This is the end of episode 27 for Great Quarter, guys. We've got some amazing stuff coming up.
Shelley Simpson from JB Hunt is doing a
Queen
keynote.
of Logistics coming up.